Good evening, everyone. Time for another silver update. This is the daily chart provided by netdania.com. You can click on the link below. And I've drawn in the two major trend lines, of course, the one from the 2008 bottom and very close to 5 or 6 touch points, especially with the latest here lining up with it. And I've drawn the downtrend line excluding this one breakout here, and you can see there's a lot of touch points here if we draw it this way. It's not quite touching here, so but you've got 1, 2, 3, 4, 5, 6, 7, 8, maybe something like that. So clearly these are the trend lines. You can draw them different ways. I'll show you in a second here. I've been requested to do a logarithmic price scale. I don't use logarithmic price scales because people don't buy and sell at logarithmic prices. They buy and sell in real prices. So my analysis is based on support and resistance, and support and resistance is based upon people who bought at a real price. They have it in their minds. They're waiting to sell when it comes back to that price and to get out even, or they're waiting to buy for support at the same price they bought. So I don't really put a lot into that. I like regular price scales. Now the other features that I've added here are the arrows, and there are 4 major arrows. They coincide with the major smackdowns, we'll call them. The recent one's not really a major one, but I put it in there anyway. The first 2 here, this is the original May smackdown, and this, I will call this a COMEX smackdown or a CME smackdown. If you'll remember, this was a coordinated attack on the 1st of May, May Day, and it was also with the announcement of the capture and death of bin Laden and the Obama birth certificate. All happened on the same date, as well as the smackdown in silver. So a lot of stuff going on there. The next smackdown was another COMEX smackdown, and this one also had margin hikes, late night, all kinds of crazy stuff. Same thing with this one, a really crazy smackdown, and margin hikes, etc. going on there. Now this third one here, this one was a Bernanke smackdown, and this was where Ron Paul showed him the silver coin, and they immediately took down silver. And again, the most recent one is another Bernanke smackdown, where Bernanke denied that they're going to be printing more money. Of course, we know they're going to be printing more money, but they're trying to push this thing off as far as they possibly can before they ultimately have to do one of these QEs, which will of course send the metals to the moon again. But they're trying to put it off as long as they possibly can, and the market was betting there that they were going to do it, and then with that terrible unemployment number, and then of course Bernanke came out and smacked it down. But you can see they are very quickly approaching that corner, being painted into that corner where they're going to have to act. They're going to have to either just go with the deflation scenario and just take this thing down, or they're going to have to print money and we go up. So one or the other, we're going to wait and see which one they choose, but the time is running out. Just to show you real quick on the view, I wanted to show you the logarithmic price scale. You can see when you do it that way, we get much more compression. I can't draw the lines because it doesn't allow me to draw lines on a logarithmic scale. But if I did draw the lines, they would be quite similar to the ones that we've already drawn, except the market would appear to be a bit stronger based on this scale. So we'll go over to the question of the night, and that is from George Silver, and he asks, who has all the money? Dear Brother John, all the world's countries, we are told, are in debt. All the world's banks, we are told, have made bad bets. Who is the person or persons who hold the IOUs and the winning bets? Who is sitting on the fat side of the equation? Now, that's an excellent question, and the answer is not so simple. You have, just as he said, the countries are all in debt, the banks are all in debt, many of the corporations are all in debt, the people are all in debt, and the question is, well, who owns all this debt? Well, everyone who's in debt owns all this debt. If you remember that comedy YouTube from Europe where they were explaining the debts and how Germany owes France, and France owes Germany, and Spain owes France, and Spain owes Germany, and Germany owes Spain, and Italy owes. It's that same sort of scenario. Everybody owes everybody, and ultimately everybody's going to take a giant haircut because everybody believes there's more money than there really is. In other words, there's actually the money's there, but the money does not really represent wealth. In other words, there isn't wealth to back that money. So there's a whole bunch of money, but there isn't nearly as much wealth. Now, question, who is sitting on the fat side of the equation? Well, obviously the person who is owed the money really isn't sitting on the fat side of the equation, because we know when collapses occur, the debtor just defaults on his obligation, and the person who's owed the money is left with nothing. So I do not consider that to be the fat side of the equation. The fat side of the equation are the people who own real assets outright without any kind of legal debt encumbrance upon them. So people who own gold, people who own silver, physical gold and silver that are not pledged to anyone else, they're sitting on the fat side of the equation. People who own real estate. If you'll notice, the quote-unquote Illuminati, or we'll say the very wealthy families, the ones that are not reported in the Forbes wealthiest, such as the Rockefellers, the Rothschilds, there's many of them, the Astors. You can go back and look at the wealthy bloodlines and families that go back hundreds, even thousands of years. They primarily own businesses, land, farms, ranches, trusts that own those things. They own real assets that are unencumbered, that don't have any debt pledged against them. Those, of course, are going to be sitting on the fat side of the equation, as they always are. But you can join them if you want to by simply buying physical silver. And if you have that, hold that in your possession and there's no debt pledged against it, then of course you as well are going to be on the fat side of the equation. So over to the story of the night. And this is a interesting story that appeared on Yahoo this morning. I caught this, kind of a jaw dropper when you look at it. But here's the headline, the blaring headline: U.S. debt load falling at fastest pace since the 1950s. So, wow, what an incredible headline. The first thing you want to say is U.S. debt, what debt? Now, as we dig further into the story, we're going to see that it's not government debt. That's actually rising at the fastest pace. But they're talking about private debt as a percentage of GDP. So we'll dig into the story and then we'll do some debunking on it. Washington, Market Watch. Everybody knows America has too much debt. What they don't know is that things are getting better, not worse. Little by little, our economy is reducing its debt burden, slowly repairing the damage caused by 10, 20, or 30 years of excess. If you want to know why economic growth has been so tepid, here's your answer. 4 years after the storm hit, the economy is still deleveraging, and it's very hard for any economy to grow when everyone is focused on increasing their savings. Okay, so here's your Keynesian Kook analysis. So what the Keynesian Kooks believe in is that economies grow by going into debt. Of course, the exact opposite is true. Anybody who's listened to Peter Schiff, anybody who's listened to any von Mises or Lou Rockwell or any Austrian economist knows that it's savings that creates the capital formation that allows the money to exist to be borrowed by businesses, which ultimately results in growth. So, of course, the Keynesians are dead wrong. They're on the exact wrong side of the argument, but they're trying to salvage the gigantic mess they've made. Continuing, total domestic public and private debt as a share of the economy has declined for 12 quarters in a row after surging over the previous decade. The rapid rise in federal debt over the past 4 years has distracted us from the big picture. The level of public debt is indeed worrisome, but it's not as big a worry as the economy's total level of debt, public and private. Although we have a whole cottage industry devoted to warning us about the dangers of too much public debt, we don't have any comparable Cassandras telling us about the dangers of too much private debt. Well, no, that's not true. It's not a cottage industry, and the people who have been warning are not Cassandras, but they've been proven right. And it's private debt is actually been growing, and I'll show you on the charts. It's barely pulling back, and this private debt has been warned about, as well as the public debt, the government debt, all of the debt. Many of these quote-unquote Cassandras have been warning about this as well, so that's a patently false statement. Yet the history of the past 30 years, or 300, clearly shows that too much debt of whatever variety can pose a systemic risk to the national and global economies. As much as we hear politicians, pundits, Tea Party patriots, and Congressional Budget Office obsessing about government debt, it was excessive private debt, not public debt, that caused the 2008 financial meltdown. And it was private debt, some of it since transferred to the public, that lies behind the current European debt crisis. Greece is unique in having a public sector that ran up spending while its private sector is rather conservative. So here's a huge assumption here that it was the private debt. Well, of course, the private debt, if you're talking about the people who owned the houses and the prices of those houses collapsed and they walked away from those houses, well, yes, that was private debt, but of course they were not bailed out. But the bankers who held those loans, they were bailed out. So that private debt was transferred to public debt. As the political rhetoric about the federal deficit has heated up, we've lost sight of the progress that's been made in bringing total debt back under control. Remember that phrase when we look at the charts here. The U.S. is actually doing much better than you'd think if you just listen to the conventional fears about how we're rushing headlong into a debt Armageddon. In fact, since the recession ended in June 2009, total U.S. debt has risen at the slowest pace since they began keeping records in the early 1950s. We'll see that that's not true as well. While Washington has taken on a lot of debt since then, the private sector has paid off, written off, or dumped on the government almost as much. As a share of the economy, debt has plunged as a consequence of rapid deleveraging by families, banks, non-financial businesses, and state and local governments. I don't recall state and local governments shedding any debt. The ratio of total debt to gross domestic product has fallen from 3.73 times GDP to 3.36 times. In the 11 quarters since the recession officially ended, total domestic debt has risen by just $702 billion or 1.4%. By contrast, in 11 quarters before the recession began, in those bubble years of 2005, 2006, 2007, total debt increased by 10.7 trillion or 28%. So I'm not going to read the rest of this, but you can read it for yourself. So here we have a 550-pound man who just gained maybe 50 pounds a year for 4 years in a row, and then now he's only gaining 10 or 20 pounds. He's still 500 pounds, approaching 600. So that's a very bullish and healthy scenario according to this writer. So let's look at some of the charts. This is one of the best charts, and this is from debtdeflation.com. This shows you, this is the most recent one I could find, and it shows you the business, finance, household, and government percentages of total debt. And this is a debt to GDP ratio. So you can see this is right here, this black line dropping here. This is what the author is referring to. So you can see, I guess he's referring to since 1950. Actually, around 1970, we had a flat line here, but we did have maybe a minor decline here in 1950. So I don't know what he's talking about. But the major decline in debt was around 1930, and you can see that was nearly a complete collapse. Looking at the chart, it seems like we are heading back into nearly a complete collapse. So that is not at all a bullish debt chart. The other chart I have here, I have to rush because I'm running out of battery. This is total debt. This is outstanding federal debt versus the GDP. You can see the GDP is flatlined, whereas the debt is absolutely accelerating to the sky. So whatever hasn't been done in the private sector, of course, has been dumped on the government, and he fully acknowledged that. So the debt is growing at a rapid pace. It continues to grow, even though many people in the private sector are broke. That doesn't mean that debt still isn't growing. It's just growing with the government. So a very strange headline, and of course one to distract the sheeple from what's actually happening, which is a very drastic drop in the solvency of the country. So back to the main chart, we have 4 smackdowns. The latest is the Bernanke smackdown. Of course, they're paying themselves into a corner. We're very soon going to see the resolution of that, and we'll talk to you next time.